You know that specific feeling you get at a house party? The music is blasting, the drinks are flowing, and everyone is laughing. But you check your watch and you realize it's 2 a.m. You know the neighbors are about to call the cops. You know the hangover tomorrow is going to be brutal. But for right now, you just keep dancing because the music hasn't stopped yet. That is exactly where the global economy is sitting right now. We are at the tail end of the wildest party in financial history, and nobody wants to admit that the cops are pulling into the driveway. See, everyone has been talking about this soft landing. You've heard it. The news keeps telling us that inflation is tamed, that the job market is resilient, and that artificial intelligence is going to usher in a golden age of productivity where we all get rich doing nothing. It sounds amazing. I want to believe it. But I've been digging into the data, not the headlines, but the boring, gritty numbers buried in bank reports and bond maturity schedules, and I found something that actually scared me. There is a specific date where the math stops working, a specific year where three massive tectonic plates of the economy are going to slam into each other at full speed. That year is 2026. I'm not saying this to be a doom monger. I'm not selling you a bunker or canned beans, but I want to walk you through the mechanics of a perfect storm. In this video, we are going to connect the dots between the AI bubble, a $3 trillion debt wall, and a consumer who is running on fumes. We're going to look at why it happens, how it happens, and most importantly, what you need to do right now so you're the one buying assets for pennies on the dollar when the dust settles. Let's get into it.
Okay, let's start with the elephant in the room. Actually, it's not an elephant, it's a GPU. Let's talk about artificial intelligence. For the last few years, AI has been the engine keeping the stock market alive. It's the reason your portfolio looks green even when the actual economy feels gray. Companies have been spending absolutely ungodly amounts of money, billions upon billions of dollars, buying chips, building data centers, and promising that this technology is going to change the world. And look, I use ChatGPT every day. I love it. The tech is real. But the economics? That's where things get messy. There is a concept in finance called return on invested capital. It's a fancy way of asking, if I spend $1, do I get more than $1 back? Right now, big tech is spending hundreds of billions of dollars on AI infrastructure. They are building the most expensive lemonade stand in history. Imagine you spent $10 million building a lemonade stand. You bought the best lemons, a diamond-encrusted juicer, and you hired a celebrity to pour the cups. But then you open for business, and you realize people are only willing to pay 50 cents a cup. You might have the best lemonade in the world, but the math doesn't work. You're never going to make that $10 million back. This is the monetization gap that experts are warning about. By 2026, the bill comes due. Investors have been patient. They've said, okay, take my money, build the models. But in 2026, they are going to start asking, where are the profits? And if the answer is, we need another 5 years and another $1 trillion, the patience is going to snap. We are already seeing signs of this. The efficiency gains from AI are there, sure, but are they enough to justify a $1 trillion valuation? Probably not. When the market realizes that AI is a long-term utility, not a magic money printer, the valuations of these massive tech companies have to come down to earth. And here is the kicker. The stock market is incredibly top-heavy. A huge percentage of the S&P 500's value is just a handful of these tech companies. If they sneeze, the rest of your 401k catches pneumonia. But honestly, if it was just a tech bubble bursting, we'd be fine. We survived the dot-com crash. We can survive an AI correction. The problem is that this AI correction is scheduled to happen at the exact same moment as something much, much worse.
This is the part that actually keeps me up at night. It's called the maturity wall. I know, it sounds boring. It sounds like something your accountant mumbles about while you're trying to leave his office. But stick with me, because this is the mechanism that triggers the crash. Think back to 2020 and 2021. What was happening? The world was locked down, and the Federal Reserve slashed interest rates to zero. It was basically free money. If you were a CEO of a company, any company, from a massive airline to a sketchy startup, you would have been an idiot not to borrow money. So everybody loaded up on debt. They took out massive loans to expand, to buy back stock, to survive the pandemic. And typically, corporate loans are structured on a 5-year timeline. Okay, let's do some first-grade math. What is 2021 plus 5 years? That is why 2026 is the danger zone. There is roughly $3 trillion of corporate debt coming due that year. Now, usually, when a company has a loan come due, they don't just pay it off in cash. They refinance it. That means they take out a new loan to pay off the old loan. It's like using a new credit card to pay off your old credit card. It works great, as long as the interest rates stay low. But here is the trap. Those companies borrowed that money at 1% or 2% interest. When they go to refinance in 2026, they aren't going to get 2%. They are going to be looking at 5%, 6%, maybe even 7%. Suddenly, their interest payments triple overnight. Imagine if your mortgage payment went from $2,000 a month to $6,000 a month starting tomorrow. Could you afford it? Probably not. Well, a lot of these companies can't afford it either. We call these zombie companies. They are businesses that are alive, they have employees, they have offices, but they don't actually make enough profit to cover their debts. They only survive by borrowing more cheap money. In 2026, the cheap money is gone. The oxygen gets cut off. So what happens? First, you see bankruptcies. The weakest companies fold. Then you see layoffs. To try and pay these higher interest rates, companies will slash costs. And what's the biggest cost for most companies? You, the employee. This is where the AI bubble and the debt wall link up. If tech companies are struggling to monetize AI and their debt gets more expensive, they are going to fire people, lots of people. And that leads us to the third and final pillar of this collapse. Because who buys the products? Who drives the economy?
It's you. It's me. It's the consumer. We live in an economy that is 70% driven by consumer spending. If we stop buying stuff, the whole machine grinds to a halt. For the last few years, the consumer has been surprisingly resilient. We call it YOLO spending. People were revenge spending after the pandemic, going on trips, buying cars, going to Taylor Swift concerts. But how were they paying for it? They were burning through their savings. And then they started racking up credit card debt. By 2026, the tank is empty. We are already seeing credit card delinquencies rising. We are seeing auto loan defaults ticking up. The excess savings from the pandemic stimulus checks, that's long gone. And we have to talk about the lag effect of inflation. Even if the news says inflation is down to 2%, that just means prices are rising slower. It doesn't mean prices came down. Everything is still 20% or 30% more expensive than it was 3 years ago. Rent, insurance, groceries, the basics of life are eating up a massive chunk of the average paycheck. So, picture the average family in 2026. Their savings are gone, their credit cards are maxed out, everything costs more. And then, the layoffs start because of the corporate debt wall we just talked about. It's a negative feedback loop. Companies fire people to save money on debt. People lose jobs and stop spending. Corporate profits drop even further. Companies fire more people. It's a downward spiral. And usually, the government would step in to save us, right? They'd print money, send out stimulus checks, and lower rates. But in 2026, they might be trapped. If they print trillions of dollars to bail out the system again, inflation, which we just spent years fighting, could roar back to life. It's like trying to put out a fire with gasoline. The Federal Reserve is going to be stuck between a rock and a hard place. Let the economy crash or destroy the currency with hyperinflation.
So, we have the firewood stacked up. We have the gasoline poured on top. We have the AI bubble, the debt wall, and the broke consumer. All we need is a match. What actually triggers the collapse? What is the spark? Prediction is a dangerous game, but there are a few likely suspects for 2026. One is commercial real estate. We all know office buildings are empty. Remote work is here to stay. But the loans on those buildings are also coming due. If a bunch of regional banks fail because their real estate loans go bad, that creates a credit crunch. Basically, banks get scared and stop lending money to anyone. If you want to buy a house or start a business, the bank just says no. That freezes the economy instantly. Another trigger could be geopolitics. I know, we don't want to talk about war, but look at the supply chain. If anything happens in East Asia that disrupts the flow of microchips, the entire AI narrative collapses in a single afternoon. No chips, no growth. Or it could be something totally random, a black swan. Maybe a major hedge fund blows up. Maybe a currency crisis in a foreign country spills over. But the specific trigger doesn't actually matter. If you build a house of cards, it doesn't matter if it's the wind, a slamming door, or a cat that knocks it over. The problem is the house of cards itself.
Okay, take a breath. I know, that was heavy. That was a lot of gloom and doom. But I want to flip the script for a second. I want to tell you why I'm actually incredibly excited about 2026. Chaos is a ladder. Every single time the market collapses, wealth is transferred. It doesn't disappear, it just moves from the unprepared to the prepared. Think about 2008. If you had cash and courage in 2009, you could have bought real estate for pennies. You could have bought Amazon stock for dirt cheap. The people who made generational wealth didn't do it when the market was at an all-time high. They did it when everyone else was panicking. If this crash happens, assets go on sale. Stocks of amazing companies, 50% off. Real estate, finally affordable again because sellers will be desperate and interest rates will eventually have to be cut. Crypto, gold, these assets tend to react violently to currency debasement. The goal isn't to be scared. The goal is to be ready.
So, knowing all of this, what do you actually do? I'm not a financial advisor, just a guy on the internet who reads too many charts. But here is my personal game plan for the road to 2026. Step 1. Cash is oxygen. In a boom, cash is trash because inflation eats it. But in a crash, cash is king. You need a war chest. I'm working on building up a 6-month emergency fund, fully liquid. If the banks stop lending, you need to be your own bank. Step 2. De-risk your debt. If you have variable rate debt, credit cards, adjustable mortgages, kill it. Kill it now. If rates spike or if you lose your income streams in 2026, that debt is the shackle that drags you down. Pay it off while the sun is still shining. Step 3. Become AI resilient. Whether the AI bubble bursts or not, the job market is changing. The safe jobs are the ones that require human messiness, strategy, empathy, complex problem solving, skilled trade work. Don't just be a cog in a spreadsheet. Be the person who solves the problems the robots can't. Step 4. Watch the yield curve. You don't need to be a Wall Street trader, just pay attention. When you see the news talking about credit spreads widening or bond yields spiking, that's your smoke alarm. That's your signal to get defensive.
Look, here is the bottom line. The economy moves in cycles. We have summer and we have winter. We have been in a very long, very artificial summer for over a decade. Winter is coming. The math of 2026 makes it almost inevitable. You can choose to ignore it. You can keep dancing at the party and hope the music never stops. Or you can quietly grab your coat, call your Uber, and get home safe before the chaos starts. I know which one I'm doing. I'm going to be tracking these indicators, the debt wall, the AI earnings, the consumer data, every single week on this channel. If you want to navigate this minefield with me, make sure you hit that subscribe button. We're going to get through this, and we're going to come out richer on the other side. Let me know in the comments, do you think we get a soft landing, or are we heading for a crash in 2026? I read every comment, and I want to know what you're seeing in your local economy. Thanks for watching. Stay liquid, stay safe, and I'll see you in the next one.